Alrighty. So today we're going to be talking about smarter long-term investing using LEAPS options. Now I've created a few other videos on LEAPS already, but in this video I want to go more in depth and give you a clearer, more well-rounded picture on what LEAPS is and how you can use it as an alternative to buying 100 shares, right, to invest in the market. Alright, so first of all, what are LEAPS options? So LEAPS is an acronym, so basically it stands for long-term equity anticipation securities. Now I don't know why that they use this P when it's not a separate word like the others, right? They just use P as part of this word instead of, just calling it LEAS. Maybe the name doesn't sound right, LEAS, so decided to use LEAPS to make it sound like it's something long-term, right? So the next thing about LEAPS, when we want to use for long-term investing, we want to ideally use the days to expiration of more than 1 year, because if you're going to use it for long term, we definitely want to buy the longest available date there is for the LEAPS, and I'm going to give you a few reasons why later on. Next, when using options as a stock replacement strategy, what we want to do is go for the deep in the money call options, right? We don't want to go for out of the money, and we also don't want to go for the at the money. We only want to go for the really deep in the money, and that's because deep in the money calls have the closest characteristics to a stock, right? So if we want to use LEAPS as a replacement for buying stocks, we want to choose the right options, right, to have the closest characteristics that simulates the stock as closely as possible, that mimics the stock. And you see, the stock, right, when we buy stock, or rather 100 shares of the stock, it is 100% intrinsic value, whereas when you buy options, there's extrinsic value. So in options, the intrinsic value is the difference between the stock price and the option strike price, and it doesn't decay with time. Right? Intrinsic value can be considered like the true value, the true cost of the option, and extrinsic value is time value, and it will decay to zero at expiration. So this is what you call theta decay. So that is why the reason we want to go for deep in the money call option is because deep in the money call options, right, they have high intrinsic value. Right, the greater the intrinsic value, the deeper the money is, and the lesser the extrinsic value. So that is why our goal is to have as much intrinsic value as possible and to pay as little extrinsic value as possible. Now, to give you an analogy of the difference between intrinsic value and extrinsic value, right? Just imagine, right, if you were to go to the manufacturer and let's say you want to go ahead and buy a bag there, right? You will find out that the cost of maybe this bag, right, if you were to buy at the manufacturer, the true cost would be around $50, right? Maybe this is the cost of the labor, the raw materials, and basically the manufacturing of the bag. It's cost you $50. Now, if you were to buy this same bag at the mall, right, it no longer costs you just $50. Maybe this same bag would cost you something like $80, right? And the reason is because they have to mark up, right, to make profit, and they bring it to the convenience. You don't have to go all the way to the factory to get it. Instead, you just go to the mall, and the mall, the shops, they have to pay rental for it, right? So that is why there's the markup. So in a sense, we can say that the intrinsic value of this bag is actually $50. But then if you were to go buy the bag at the mall, you have to pay a markup of $30. So this $30 can be seen as extrinsic value, right? So as much as possible, right, as smart investors, we're going to buy our options, rather our options to have as much intrinsic value as possible, or rather to be as close as to the intrinsic value as possible, and not pay so much in terms of the markup. So for LEAPS option, you have to understand that this is nothing but a leverage tool to help you magnify your returns, but it can also be a double-edged sword, right, if you do not know what you're doing, right? It can definitely give you higher returns because you have lesser capital at risk, but on the downside, you still have risk as well, and it also magnify your losses in terms of percentage-wise, because your losses will be upon the capital that you put in, right? So I'll give you more explanation later on. But ultimately, the key to success in LEAPS comes down to the underlying stock selection and also the direction of where the stock is headed the moment you buy it, right? So you hear, like, sometimes you hear a lot of people say that, they lost a lot of money buying LEAPS. Well, the thing is, not necessarily that you lost money in LEAPS, but rather you lost because the underlying stock selection that you chose just went to zero or just went all the way down, right? Because if you chose a stock that is going to go down ultimately, it doesn't matter whether you're going to buy a LEAPS or you're going to buy stock, right? You're still going to lose money. So this is very important to understand. LEAPS is just a tool on the underlying stock, right? So if the underlying stock selection is no good, if the stock goes down immediately, then you're going to lose regardless whether you buy shares or LEAPS when it comes to investing. All right, so here is the risk profile comparing the 100 shares and the LEAPS option. So if you will take a look on the left hand side, this is for the stock. We will see three lines which I have put up down here. So we want to compare the losses and the profits to each other to see how it goes, right? So this is the first point, is at $50. So it's at $50, you see that it loses $6,500, right? For the strike of the 55 strike for the deep in the money call LEAPS option, we actually lose less, right? We lose $5,197. And you notice that there are two lines down here. There's this purple line and the blue line. So the purple line is basically the amount that you stand to make or lose today itself, right? Based on today, this is where the purple line, and over time this purple line will slowly start to conform to this blue line. Basically, it will go down to become this blue line, and the reason is because of extrinsic value. Extrinsic value will decay over time, right? So first off, right, you notice that as the market drops immediately, you actually do not lose your max loss first, right? And if you were to take a look at the max loss is $6,275, anywhere from $55 all the way to zero. That means you cannot lose more than that. Whereas for the stock, you see from this point on, you still can continue losing your money, right? That's because the stock, there's no cap to the downside. In a sense, you're going to lose your capital all the way down to the $0 where the stock goes to zero. Whereas for LEAPS, your loss is capped to how much you paid. So in this case, the max loss is $6,275. Whereas for this, if you paid $115 per share, 100 shares, you're going to lose $11,500. Now let's take a look if the stock actually went up to $100 or $150. So at $150, the stock makes $3,500, whereas the LEAPS only make $3,326. You can see it's actually not too much difference, right? You make slightly lesser, right? But it's not that much difference. Whereas on the downside, you only lose about half of what you're paying for this, right? 100 shares, you're going to pay $11,500, whereas for the LEAPS option, you pay $6,275. So that's slightly more than half. So that is why for the LEAPS, you have a capped downside, where the loss is really limited to about half, right? If you want to choose up to half of what you pay for the 100 shares. And then on the upside, you mimic very closely to about 100% of the profits that you make. So that's why the LEAPS can be a very great tool to help you grow your account. Okay, now let's take a look if the stock price is at $100. So at $100, you can see it loses very little compared to this. All right, this is about $1,500, whereas the LEAPS lose $1,358. So the whole idea down here, the reason why that you're not losing as much compared to when it's close to the expiration date is because extrinsic value, before it actually expires, helps you cushion your loss as it goes from in the money to at the money, right? You notice down here that the gap is the greatest down here, right? Remember, your strike price is at 55. So at 55 is around here. You notice your gap is the biggest down here. Whereas when it's in the money down here and out the money down here, the gap is the least. And the reason is because of how the extrinsic value actually expands as it goes to at the money. So I'm going to give you a graphical representation here. So let's say, for example, this is where you bought the LEAPS, right? So you will buy the LEAPS. Let's say we use the example of 55 LEAPS. So right now the stock, right, is at $100. Okay, and then you bought the LEAPS of a 55 strike. So at this point of time, it is very deep in the money. It's considered in the money. So this is where your extrinsic value lies, right, at this point. Now, as the market goes up, let's say the market goes to $110, right? Let's say it goes to $110, your extrinsic value starts to actually decrease, right? Because it becomes even more deeper in the money. So in this case, you gain intrinsic value, but you lose extrinsic value, right? Now let's take a look about what happens on the other side. Now, as your strike becomes at the money, that means as this stock from $100 drops to your strike price of $55, you notice that the extrinsic value actually gained, right? While you lose in terms of your intrinsic value from the stock drop in terms of the price, you actually make money in terms of your extrinsic value. Your extrinsic value gain in value to help you cushion the losses that you made on the intrinsic value. Now, as it goes further down, right, if it drops below $55, of course, slowly your extrinsic value will start to drop as well. So you can see this is the bell curve, right? So as the market transitions from in the money to at the money, you make the most extrinsic value gain. But as it drops even further until it's out of the money, there's almost no value left, right? Your extrinsic value also basically almost goes to zero as time passes as well. So what this means is that as the market drops, you actually have some protection because your extrinsic value comes in to help support you. So I'm going to show you the option chain right here so you can really see. If you can see this option chain down here, this is the deep in the money 55 strike. You notice the extrinsic value is $2.80, right? And as you get to the at the money of where the stock is right now, around $110, you notice that it becomes much thicker, $17, $19. You can see this is a bell curve, right? You can see that the extrinsic value becomes the greatest at the money, right? And in the money and out the money has the least. So what happens, like I mentioned before, your extrinsic value will actually help you cushion the losses as you lose money on the intrinsic value, right? Okay, intrinsic value is just the difference between the strike price and the current price of the stock, right? So as the stock goes down, you lose intrinsic value, but your extrinsic value will start to gain to help you cushion that loss. So the role of extrinsic value can be actually positive for you as you're losing money, right? But don't forget that extrinsic value will still decay to zero over time. Now, I want to show you the graphical representation in terms of the value so you can understand a little bit better how this extrinsic value actually comes in to help you when the market is dropping, right? When the stock you're choosing is dropping. So down here, this is the stock price, right? Imagine the stock went up and come down this retracement. You say that, all right, I want to go ahead and buy at this price, all right? So we will compare two things. We will compare 100 shares and we'll compare buying the deep in the money call LEAPS, all right? So this is the strike price for the call LEAPS, right? Because we buy deep in the money, it will always be below whatever the value of the stock is right now. So let's say the stock value is at this price. You can see this is the full intrinsic value. So I've marked the bar to match the intrinsic value of where the stock is. So let's say if the stock is at $100, then your intrinsic value of the stock is $100. Now, whereas for the deep in the money call LEAPS, you notice that you're actually only going to be paying up to where your strike is, right? So let's say, for example, if this is the 50 strike price or the 55 strike price, you're only paying the intrinsic value from where the current stock price is to the call LEAPS strike price. So you're only paying this much in terms of intrinsic value. And don't forget, we also have to have extrinsic value because we're paying for time value. So this is the extrinsic value portion of the call LEAPS. All right, so let's take a look at how it actually goes when the stock goes up or down. So now let's say the stock goes down, right? So it dropped this much in terms of intrinsic value. So if you were to see, I've also color coded the bars to match the intrinsic value loss. So if the shares, or rather the stock, drops by, let's say, $25, your stock intrinsic value will drop by $25. Your call LEAPS intrinsic value will also drop by the same amount, right? It drops by the same amount by how much the stock drops, right? That's intrinsic value. Now, what about the extrinsic value? You notice that the extrinsic value actually gained, right? You see, if you compare the one before, right, intrinsic value dropped, but extrinsic value actually gained. So instead of losing this much, right, you are being actually cushioned. Your loss has been cushioned by the gain, by this part of the extrinsic value that gained in value. Okay. Now, what if the stock goes up? Now, if the stock goes up, right, because you can see now this is the additional intrinsic value gain. So on your call lips, you actually gain the same amount in terms of intrinsic value, right? But then your extrinsic value actually drops, right? It decreases, right? You see, before your extrinsic value is this amount, but because the stock went up, although you gain in intrinsic value, your extrinsic value reduces a little bit. So your gains are a little bit muted, a little bit decreased, because these gains a little bit offset by the loss that you made on the extrinsic value, which is not much, right? So this is what happens when the market goes up. Now, what happens if the stock suddenly crash and it crashes past your call lip strike price? So this is what happens, right? So for the stock, intrinsic value is very straightforward. You lose whatever intrinsic value from where the current stock price is to where you first bought it at, right? So this is how much you lost, right? Whereas for the call lips, you notice that you cannot lose all the way past here because you only paid your intrinsic value up to this point. So your intrinsic value, you already lost everything. You only can lose what you paid in terms of the intrinsic value. You cannot lose more than that, right? So that's the beauty of the call lips, is because you also kept your intrinsic value loss. Now, on your other hand, right, your extrinsic value actually gained in value. You notice it gained so much in value to help you cushion the loss of this intrinsic value. Again, you see, if you were to compare at where you first bought it, you see, when we first bought it, your extrinsic value is this much, your intrinsic value is this much, right? But when the stock crashed below your strike price, look at this, your extrinsic value has actually expanded that much, right, to help you cushion any losses here, so you do not have the full impact of the losses from this intrinsic value. So again, that is why the LEAPS, the call LEAPS, deep money call LEAPS, has this protection against the stock crashing through the form of your extrinsic value expanding. Whereas for stock, there is no protection whatsoever. Whatever you lose in terms of the price is what you lose in your stock's value. All right, now let's say, for example, the stock comes back up to exactly where you bought it, right? Where you bought the strike at, where your stock is at, right? So the stock, you can see the intrinsic value goes back to where it originally was. So at this point in time, you do not make money, you do not lose money, right? But what about the deep in the money call lips? You notice that the deep in the money call lips, right, your intrinsic value has been reinstated to the same amount as when you first bought it, but your extrinsic value actually decreased in value. Why? That is because of time, theta decay, right? You see, at the beginning when you first bought it, your extrinsic value is this much, but after some time, right, the stock price goes back to the same, but now your option value, your deep money call list, is actually now worth lesser than when you first bought it because of this extrinsic value. So while extrinsic value actually helps you when the market is going down, don't forget that it is actually still decaying over time, right? It's slowly decaying and slowly picking up speed as lesser time is left in the expiration of the option. So that is why we need to really understand theta decay. We need to understand how it works, right? So this is the theta decay graph. As you can see, that the theta decay, right, is the least when there is a lot of time left in the option, right? And it really starts to pick up speed around the 45 days mark, right? You notice that around the 45 days mark, the curve starts to become much steeper, and it becomes even more steeper as it goes to zero. So as an analogy, right, I like to compare this as though like you are holding an ice cream, right? You are eating ice cream and the ice cream will melt over time, right? If you don't eat it, you just leave it there, it will definitely melt because of the weather. Now, there is a difference in terms of weather by the number of days left to the expiration. So the longer days there is left, it's like you're eating ice cream in winter, right? Does it melt? Of course it will melt, but it melts very slowly, right? It melts very slowly. But as it gets closer to the expiration date, right? Suddenly now you're no longer eating your ice cream in the winter. You're starting to eat it in the hot summer. So as it gets closer and closer, the temperature becomes hotter and hotter, and that's where it starts to melt very quickly. So the theta decay is not uniform, right? Your extrinsic value does not decay uniformly. It's not the same amount every day, but rather it starts off very little and it starts to really pick up speeds towards the end of the expiration of the option. So if you will take a look at the option chain, you can see it very clearly down here, right? So if you take a look at the 537 days to expiration down here, you notice that the theta decay, right, this column down here shows that you're only losing 2 cents a day, right? You're only losing 2 cents a day. But as you get closer to the expiration, right, you see this is 19 days left, you notice that the theta decay becomes 9 cents, right? And here's the interesting thing. You see, you notice that you actually have very little extrinsic value left. So by logic, if you have very little extrinsic value left compared to if you have a lot of extrinsic value left, the theta decay should be more here, right? But instead, it's actually more as it gets lesser. And again, that is because of this graph down here. It really picks up speed only closer towards the expiration date. So that is the reason why we always want to go for the furthest days to expiration for the option, because it gives us the least theta decay, right? It gives us the least theta decay. This way we have much more time for the option to be right. So that's the main reason why I want to go for a very long dated option, right? The other reason is because when you buy the long-term expiration, you notice you actually have it cheaper, right? You buy it cheaper. It's almost like a bulk deal, right? If you were to buy something, right, in bulk, it's always cheaper when it comes down to the cost, right? Let's say if you buy maybe a bottle of mineral water costs you $1. But if you were to buy 10 of them, it may cost you $5. So the cost is 50 cents for one because you buy in bulk. When we come to buying extrinsic value, right, it's the same, right? You notice that it's actually much cheaper if you buy in bulk. So how do we know? We can just calculate this. Okay, let's just take a look at the 110 strike price. How much do we pay per day for extrinsic value? So we just take 1.705, all right, which is the extrinsic value we're paying for here. We divide it by 19 days. So we're paying roughly 8.9 cents. So let's round it off. That's 9 cents per day in terms of extrinsic value. But what about this? So we take $17.105, same strike price, and then we divide it by 537 days. Look at that. So we are only paying 3 cents, right? Whereas if you bought the 19 days to expiration, you're paying about 9 cents. So that's 3 times more. So that's also the reason why we want to go for the longest dated option, because you get it the cheapest in terms of per day, the extrinsic value which you're paying per day, plus your theta decay is the lowest. So that's the reason why for long-term investing, we always want to go for the longest dated ones, okay? The next thing to understand is what to do when it's near expiration date, right? When there's only left 60 to 90 days to expiration for your LEAPS option. So this is where a lot of people get confused. So what I want to do is I want to share with you what you can do when it's close to expiration date, so you know exactly what to do without feeling confused, right? So first of all, if your LEAPS option is in a profit, you can just simply close out to take the profit, right? And if you're still bullish, you can reopen a new dip in the money called LEAPS. So chances are that if you're in profit, right, let's say you bought at a 90 delta call LEAP option, chances are you may have gone up to maybe close to 100, right? If the stock really went all the way up, right? At this point of time, you can sell it off for a profit and then you reinstate the 90 deltas again. Now, but what if you are in a loss, right? If you're in loss, this is where the huge confusion comes, which is where you want to really pay attention next. So there are 3 options that you can choose, all right? So the first option is that if you're no longer bullish on the stock, all right, then you just simply close for a loss. There's no point for you to roll to extend your losses, right? Because when you roll, you have to add more capital to it. So you can always reinitiate another dip in the money call LEAPS when you're bullish again, right? So if you're no longer bullish, just close it out for a loss, take the loss. Now, option B, if you're still bullish for the long term, then you can actually just exercise the option at expiration, right? When you exercise it at expiration, basically, you will just long the 100 shares on the strike price. Now this is only if it's in the money. So for example, you have a strike price of 55, and let's say you initiated this leap when the stock was at $100, and then close to expiration, or rather expiration, the stock is roughly around, maybe let's say $70. Your strike is actually still in the money. So what you could do, you could just leave it to exercise, right? If you leave it to expire, the broker will just exercise you when you're in the money, and then you'll be long 100 shares at $55. All right. But this also means to ensure that you actually have the capital to long another 100 shares. At this point of time, you just have to hold on to it and wait for the stock to go up again, right? Now, if you do not want to convert it to stock, right, you want to have a more efficient way to use your capital, you can go for option C, and that is to roll this LEAPS to extend the LEAPS life. Right, so when you're rolling, you're essentially just closing it out, take a loss, and then you're initiating a new LEAPS again. So when you're rolling this, there are two options you can take, right? You can either roll to the same strike. So let's say you roll from the 55 strike to the 55 strike again, but you go to the furthest away days to expiration. This way you get to keep the intrinsic value, right? Because your intrinsic value will be still the same as when you first paid for it, but then you will have to pay additional extrinsic value, and this is the most extrinsic value, because when the market, or rather when the stock goes very close to where your strike is, remember we talked about this, that as the market drops closer to at the money, which is where your strike price is, your extrinsic value becomes the highest. So when you're rolling at this point, you have to pay for the most extrinsic value. Right. On the other hand, if you don't want to roll to the same strike, you can roll to re-establish the same initial delta. So what this means is that you have to top up the intrinsic value. That means also you have to pay for the portion of the intrinsic value which you did not pay for previously when you first bought the LEAPS, right? And then you just have to pay a lesser extrinsic value compared to if you roll to the same strike. Now, this may seem confusing, but bear with me, I'm going to show you an example here. Right, so this is a real example. So I actually have a LEAPS right now on the CRM, which is Salesforce. You can see that the strike price which I bought for is 115, right? And I paid $115 for it. So I paid $11,500 for it. And I bought this LEAPS when the stock was trading roughly around $230, just slightly under $230. So that means I paid about 50% for it. Okay, so you can see this is the current value right now. It is $73, right? So I lost roughly like $42 on this, right? So that's $4,200. This is the extrinsic value which I have left, and this is the current delta, right? So at this point of time, you gotta ask yourself a question. So am I still bullish on Salesforce, right? If the answer is yes, then this is where I'll do a roll. So there are two ways to roll, as I mentioned. First, you can roll to the same strike price. So my strike price down here was 115, right? So I will roll it to the same strike price at 115. You notice if I were to roll it, I only pay $9.08. So it's $908, right? The reason is because I do not really pay that much in terms of the intrinsic value, because I pretty much just kept the same intrinsic value as when I first initiated the LEAPS. The only thing I'm paying additional is this extrinsic value. So you notice now I'm paying $13 in additional just to extend my LEAPS life, say from the 173 days. By the way, this 173 is how many days till expiration. So by extending from 173 to 537 days. So I'm paying $13.11 for this extension in time, right? The strike price doesn't change. So when I pay in terms of this extrinsic value, my break even also increases. So this is very important to understand, right? So previously, right, my break even is simply the strike price plus what I paid for it. So that's $230. So that means if the stock goes up to $230 by expiration, I don't make money, I don't lose money. But now because I have already extended this, right, let's say I've decided to roll to 115, I have to pay an additional $13. So what it means, I have to add it on to my initial break-even price, and this becomes my new break-even price. So my new break-even price becomes $243.11. It means by expiration date, the market has to go up. The stock CRM has to go up to 243.11 to break even. Anything above that then is a profit at expiration. So this is what I'm paying additionally that I'm adding on to my break even. Now, if I were to roll to the 80 strike instead, What I mean is that I'm trying to gain back the initial delta which I sold it for, right? Sorry, when I bought the leaps for. When I first bought the leaps, delta was roughly around 95 deltas. So this is very close to it. So I'll be getting back the same delta, but then I'll have to pay much more. You can see this time I have to pay $38. So this is $3,805. So what does this consist? Basically what I'm doing is I'm topping up the intrinsic value from 115 to 80. Right, I'm topping up this intrinsic value, which I'm now going to have to fork out my pocket to pay it, and then I'm only paying $7.08 compared to this $13 in terms of extrinsic value. So that means my extrinsic value which I have to pay is lesser by about half, almost half, right? So what is my break even for this? So my break even will be now 230, right, plus the $7, right, $7.08. So what is the break even now? The break even now will be about $237. So $237 is definitely much easier to reach than $243, but I have to pay more for it. But I'm paying in terms of intrinsic value. So if it comes to me, if it was me, I definitely would want to roll it to this, because I will keep most of it in intrinsic value, because in my mind I would have already bought 100 shares of CRM at the start, right? That's all intrinsic value. So rather than pay more extrinsic value, why would I want to pay the markup, right, when I can just top up the intrinsic value and then pay lesser extrinsic value? This way it's easier for my option to make money as the stock goes up, right? So the other thing to take note of is this delta. You see, at this point of time, it's 92 deltas. If I was to roll to the 115, suddenly the delta becomes 87. So what it means is that as the market actually went down, right, from the point in time when I first bought the options, I actually lost 92 deltas on the way down, right? I would lose like 95 deltas, 94 deltas, 93 deltas. And if you really remember what delta is, basically it is the value of the option, whether it increases or decreases based on the dollar movement of the stock price. So every dollar that the market is going down, the CRM is going down, I'm losing 92 cents or $92 in terms of 100 shares, right? So this is very important to understand, because if I were to lose $92 or 92 deltas on the way down, if I was to reinstate this, I only make 87 deltas on the way up. So that doesn't make sense, because I'm losing more on the way down, and then and on the way up I actually make lesser. So this means it has to go up more in order for me to make back the loss which I had on the way down. So rather than do this, I want to reinstate a higher delta. So this way, when it goes when the market goes up, starting from 94 deltas, right, I will make more on the way up than it is on the way down. So this means that the market doesn't have to go up that much in order for me to make back the loss which I had here, right? So if the market comes down this much, let's say based on 92 deltas, all right, if the market was to just go up somewhere down here, it doesn't have to fully go up down here based on the 94 delta, because this, don't forget, this is dynamic delta. The delta will increase as it goes up. It means once the market reaches this point, I would have pretty much already made back what I lost at this point in time. All right, so this is important to understand when it comes to rolling. Okay, so let's take a look at some pros and cons of owning stock versus buying deep in the money call leaps. So the pros for the stocks is that there's no expiration. So this is very straightforward and easy to understand, because this way you don't have to worry about, you know, the option expiring, because there's no expiration date. So you do not have to worry about how to roll or when to roll, right? Unlike deep in the money call leaps, you do have to worry about rolling and know how to roll when it gets closer to the expiration date. Now for stocks, it's 100% intrinsic value and there's no extrinsic value. So you do not have to worry about theta decay in this sense. And for stocks, you can receive dividends. Now, whereas for deep in the money call leaps, you have limited downside. And because of this, right, you have lesser capital at risk, because you can put up, you know, as little as 50% of the cost you will put up for 100 shares, or you could go slightly even lesser if you want to have a lesser delta. But basically, you will have much lesser capital at risk compared to stocks, because stocks you have to pay the full value of 100 shares. Now, with deep in the money call leaps, you also have higher returns, because your returns, as you have already seen in the P&L graph, the profits is actually very similar to stocks. Now, the difference is that we have lesser capital at risk. So if we were to divide it by the amount of capital which we put up for the call leaps, our return is actually higher in terms of percentage. And there's also dynamic delta, right? So we've seen that dynamic delta means the delta moves as the stock moves. So if the stock drops, the delta will actually drop as well, which means you start to lose lesser as the stock drops. But on the way up, the delta actually increases. So this way, you make more as the stock goes up. So extrinsic value in the deep in the money call leaps actually also help to cushion losses as stock drops, right? So as we have already seen, there's this bell curve, right? So this bell curve, we always start off with the in the money over here, right? So we are buying the deep in the money call leap. So this is the value of our extrinsic value which we have purchased. Now if the stock is to drop, our in the money will start to shift to at the money. So at the money, this is where the extrinsic value is at its highest. So that is why we are able to cushion some of the losses, because although the intrinsic value we have lost, we have actually gained in our extrinsic value, and that helps offset any losses in the intrinsic value. Alright, let's take a look at our cons. Now for the stocks, we have more capital at risk because, as I mentioned, we have to pay up a full, the full cost for 100 of shares, and because of that we have lower returns, and there's no extrinsic value to cushion the loss. So in a sense, there's no protection to the downside in the form of extrinsic value for stocks, right? Now for deep in the money calls, although extrinsic value helps to cushion the losses as it drops, you must remember that there's also the theta decay. That means as it gets close to the expiration date, it will start to lose its value and ultimately become zero at expiration. So you must always keep this in mind. So when it gets closer to the expiration date, this is where you will need to roll. And when you roll, you will need to add capital to extend the LEAPS life, right? You add in capital, that also means that you're increasing the risk, the overall risk to the call LEAPS, right? So let's say, for example, if you bought the call LEAPS, let's say you bought it for $10, so $10 will be $1,000. Now, if it's getting close to the expiration date, right, you want to roll it. So as you roll it, you might need to top up maybe another $2 for it. Right, so if you were to top up $2, now your total risk on this call leap would be $12, which means if the stock, let's say Touchwood, does go to zero, you lose an additional $2 on top of the $10 which you've already put in. So this is something to keep in mind when you're getting into, or when you're buying deep in money call leaps. And finally, there are no dividends for options, right? So that is why it's always better to use it on non-dividend stocks. So I would rather use this on like tech stocks, because they do not really pay any dividends, or if they do, they pay very little. So this way, right, you do not lose out on any dividends because they don't pay out any dividends in the first place. Alright, so let's have some final takeaways. So the very first takeaway is that deep in the money call leaps is a great replacement tool, or is a great replacement strategy for buying stock, right? Because you have lesser capital at risk, which is very important compared to stocks, and you have the same unlimited upside as stocks, right? So if stocks go all the way to the moon, right, your leaps the value can also go to the moon as well. So thus you have a greater return compared to stocks. Now, deep in the money call leaps have intrinsic value and extrinsic value. So intrinsic value is considered the true value of the option, whereas extrinsic value is considered the markup we have to pay. And if you recall, we have this example where I talked about the bag, right? So if you were to go to the manufacturer of the bag, maybe you would probably only pay $50. That's the true cost of this bag. But if you were to purchase the same bag at the mall, right, you would have to pay a premium, right? Maybe the bag, they charge you $80 instead of $50, right? So you're paying an additional $30 in terms of premium, right? So premium in terms of extrinsic value. So when we are buying options, we always want to buy as much intrinsic value as possible, or rather as close to the intrinsic value as possible, and we want to pay as little extrinsic value as possible, because ultimately we already know extrinsic value goes to zero. So next, extrinsic value helps cushion any loss of intrinsic value as the deep in the money call leaps goes from in the money to at the money. Again, this is the bell curve which I mentioned earlier, but it also ultimately decays to zero at expiration. So we need to balance both of them, right? We know that it helps cushion, but at the same time, as it gets closer, the value of this cushion can still start to drop down to zero. Hence, we always want to buy the furthest dated expiration, because when we do that, we are sort of buying buying extrinsic value in bulk. When we are buying in bulk, we actually pay lesser per day in extrinsic value, and that also gives us the slowest theta decay, because if you remember, the theta curve, they do not decay at the same rate. The decay starts to pick up, right? This slope starts to become steeper as it gets closer towards the expiration day. So if you recall, I used the analogy using the ice cream, and this being winter on this side where it's very cold, winter, and this is summer, right? So as much as possible, we want to get our options, the deep in the money call LEAPS, towards this side of the theta decay curve, which is the furthest expiration date that we can buy. Next, when it's close to expiration date, roughly around DTE 1690, right, we can either, if it's in a profit, close for a profit, and we are still bullish, just reinitiate another deep in the money call this position. So this is also another roll, but in this case, we actually do not have to top up money. When you are in profit and you want to roll it, you're actually taking profit on it, right? So that's the difference between rolling for a loss and rolling in a profit, right? So if you're in a loss, you have three options, as we've mentioned. So the first thing is to close for a loss if you're no longer bullish, right? Then you can wait until, you know, the stock gives you a good signal where you feel it's going to go up again, then you can re-enter into another deep in the money call LEAPS. Now, option B is that if you are still bullish, right, you can choose to exercise the option to long 100 shares, right? Basically, you only want to exercise it at the end of the expiration, right? You don't want to exercise it when there's still some time value left, because if you were to exercise it when there's still time value left, where there's still extrinsic value, then you're foregoing any extrinsic value. So this exercise option is basically only if your option is still in the money at expiration, then you can choose to exercise it, and then you just top up the remaining amount which you need to buy the 100 shares. If you do not want to do that, the other alternative is to roll, right? So you want to roll to the furthest days to expiration. So either at the same strike, right? This way you maintain the same intrinsic value, but you have to pay much more in terms of extrinsic value, or you can just reinstate the previous delta. So in this case, you have to top up more capital, because you're actually topping up in terms of intrinsic value more, and then you're paying slightly lesser, right? You're paying lesser extrinsic value compared to if you were to just roll to the same strike. Now, finally and ultimately, the success of your core LEAPS as a stock replacement strategy still comes down to whether the underlying stock goes up or not, right? So you have to understand that if the LEAPS lose money, it's not because LEAPS is not a good tool, but rather because you have chosen the wrong stock, or when you bought it, the stock starts going down, right? So the direction has to go up in the long term. So ultimately, it is just a tool to help you enhance your profit and reduce your risk, but it doesn't prevent you from losing money at all. That ultimately comes down to choosing the right stock. Alright guys, I hope this video has been helpful for you, and if it has, I'd appreciate if you give me a thumbs up as well as subscribe to my channel. And as always, thank you for watching. I appreciate your time, and may the options favor you.